For the month ahead of September, is the crypto market and the stock market going to crash and burn, or is it going to go up? We'll look into those answers inside this video. One thing to just remember, as far as Bitcoin is concerned, September is a pretty bad month seasonally. It doesn't automatically translate into sell everything and run for the hills. When looking at the average S&P 500 returns, and this is since 1950, you can see that September is a pretty bad month. Now, what has that got to do with crypto? Just like road rules, there's a lot of rules inside financial markets, and Rule 225 is a really important one. Bitcoin cannot escape the stock market's gravity. If the stock market is weak, Bitcoin is likely to feel it first. That's why, if you're not inside the crypto market and you're not trading or investing in Bitcoin or any alts, you're just basically inside the stock market. That means keep your eye on Bitcoin, and I'll explain why. The easiest way to interpret this rule is to look at the S&P 500. The S&P 500 and the NASDAQ comp, and we'll look at the NASDAQ as well. Just a little bit later on. You can see this white line. This is the S&P 500. This is the major market index inside the stock market, the US stock market. What do you see is the relationship between Bitcoin's price action, which is the candlestick chart, and the S&P 500, which is that white line. Do they follow each other? Do they follow each other down? Do they follow each other up? Do they follow each other when they're turning around? Do you see any relationship between these two charts? If the S&P 500 is going up, do you see Bitcoin going up? If Bitcoin is going down, is the S&P 500 going down? If Bitcoin and the S&P 500 are coming up, do they do it together? This is a really important question. And unfortunately, when people are fresh into markets, they will just look at one chart and they will say this chart controls the entire financial market system. For example, those inside Bitcoin will say, the S&P 500 got nothing to do with crypto. Crypto is independent. Unfortunately, it's not. It's never been and it never will be. Now, what does this mean to us? If we're going to make informed decisions, just manage your risk effectively. You'll need to know how the S&P 500 and Bitcoin intercorrelate, which means move together. Let's dig into this diagram a little bit more. We can see that as Bitcoin was coming up, the S&P 500 was looking fairly strong. It just basically went to an all-time new high here, and then it sold off dramatically. Now, what happened to Bitcoin during that same time? Do you notice this divergence? Now, what does that mean? Just think about the S&P 500 and Bitcoin as being boats on an ocean, the financial ocean. The SPX is a huge boat. It's like the Titanic. And Bitcoin is kind of like it's a much smaller boat. Let's make it like a speedboat. So the speedboat can turn around quickly, but the Titanic, it's going to hit that iceberg. Now, what do we see currently inside Bitcoin's price action? It's been reducing over the past 2 weeks. Now, what do we notice here? It was reducing as well. When we look, and why is this called retail analysis? Retail is unfortunately just another word for loses money consistently. Call out to Purpuratum. Now, what we see down here is the RSI. You can see the RSI, it's very oversold, and people would just expect to bounce up. But if we take this line across to the same kind of period where we're seeing the same or similar things occurring, it's occurring around here. Did we get a bounce up? Did it continue? We got a little bit of a bounce, that is for sure. But that little bit of a bounce was met by some extreme selling action. Now, a lot of people would step in when the RSI goes to wildly oversold levels. Would that have been a good idea to buy around here? Well, it depends on your strategy. If it was a dollar cost averaging strategy, sure, no problem. But did it pin the bottom? Was this RSI call the bottom? Absolutely not. You can see the RSI was improving while price was going down. This is why retail analysis although really interesting stuff and good to do, you should look at primarily at structure. What about if we look at moving averages, say the 100 period, 200 period, all of those different periods? Well, what are we seeing here? We can see that 200 period moving average. Did this hold price? Well, you can say it did, you can say it didn't. Well, what about the 50? What about the 100? This is not realistically the issue at all. For example, I'll just make it really practical. When you look at the 200 period moving average, it's down around that 104 area. Now, where is the resistance above that particular moving average? Where is the support below that particular moving average? You might say, oh, Ken, that's pretty easy. I'll just, lower the EMAs or SMAs. I'll just lower those levels. I'll make it a 1 period moving average. Now, what is a 1 period moving average? Please let me know in the comments. If you know what a 1 period moving average is, you are a superstar and you actually understand moving averages. Don't just say, I know it, tell me what it is. Our key right now is to just understand where retail is looking. Now remember, retail consistently loses money. Become an institution of one. If somebody ever says, you're a retail trader and investor, say, no. I'm an institution of one investor or trader. What about if we looked at the NASDAQ futures in relationship to Bitcoin? We've done the S&P 500 futures. You can see the NASDAQ was going up when Bitcoin was coming down. Now, what did this divergence tell us? It told us that under the hood, the speedboat of Bitcoin was getting buffeted by financial tsunamis. Let's also take this analysis a little bit further. If you were inside the crypto market and you unfortunately pinned the top, just say it was 109,000, you would in no way ever believe that 109 can turn into like 75,000. And this is why it's so utterly important to know where the structural passes and structural failures are inside the price chart that you're looking at, and also to just marry up different charts so that you understand the sentiment inside the market. For example, if Bitcoin is coming down like this, you know the alts can't escape Bitcoin's gravity. If Bitcoin is coming down by, say, 10%, the alts are probably coming down 30%. Just to help out, I've thrown the indicator on from the monthly service. Now the service indicators will be updated, but not today. Even though it's the first, the markets have not clicked over. Structure is created through 2 levels of standard certification. It's really important you know when to mark up your charts. So the structure from last month, which has still got some carryover at the current time, around that 103,635 level, just going down to the 98,445 and in between this zone. So let's just take the lower area of that zone around the 93,000. This is if the crypto market and the stock market sell off. How can we stack probabilities? Typically, the shorts get really excited when price comes down because that's how they make their money. They sell first and buy back later, whereas long does the opposite. They buy and sell later. So what we see here, when we're looking at the Bitcoin shorts, they've been coming in. This is kind of similar to this price action. Now, if we start to see big surges up in the shorts, it's likely to be because of things like this. So please keep your eye on that. It's important not to get too negative. We're just stacking probabilities. It's not a bad idea to keep your eyes on the Bitcoin longs as well. You notice that there was a lot of dip buying going on here from basically January through to April. But what happened then? As pretty much at the bottom, all of the longs said, I've had enough. We see a lot of this kind of action inside the market. A lot of retail traders and investors go long in terms of Bitcoin. So it's important to be aware of that word. Now, one thing that we do see, there's a lot of dip buying going on at the current time. It's just getting started in many respects. Now that's an inherently good thing. If there's more buy pressure coming into the market, that's typically supportive of price. So it's not actually the longs and the shorts that are the real issue. It's intercorrelation between charts. If the S&P 500 and the NASDAQ are selling down, your going long won't make any difference. Therefore, we must pay a lot of attention to the S&P 500 structurally, the NASDAQ structurally, and Bitcoin and total structurally this month. But Ken, I'm not in Bitcoin, I'm not in the stock market, I'm in Solana, I'm in Doge, I'm in XRP, I'm in ADA, I'm in something else, but I'm not in those things. Okay, fair enough. Rule 45 is a very important rule. No alt can escape Bitcoin's gravity, and we know that Bitcoin cannot escape the stock market's gravity either. Now, what does this mean? It means something really, really important. You must look at Bitcoin, even if you're only in ETH. Now, why is that the case? Well, if Bitcoin comes down, we anticipate that the alts will bleed more than what Bitcoin does. And in some cases, it can be huge multiples. Look at this on the last 7 days action on Bitcoin. When Bitcoin came down, did Ethereum go up? No, it came down. What about XRP? Did XRP just go the other way? No, it didn't go the other way. What about BNB? Did it just say, Bitcoin is coming down, I'll go somewhere else? No, it went with Bitcoin. What about Solana? Did that come down? What about Tron? Did that come down? This is very important to understand. Okay, Ken. That's from a down perspective. Oh yeah, I can see. Yes, Bitcoin. Wow, you got a point here, man. If Bitcoin comes down, yeah, the alts come down as well. But there's another really neat part about this thing. Of course, if Bitcoin is coming up, the alts will also come up. Sometimes they can come up longer, sometimes shorter, but they're always marrying in with that directional association. I'll give you a little tip. When I look at heat maps like this, I see Bitcoin coming down. I would anticipate and expect the alts to be bleeding far more, and we already saw that. A lot of people get confused and they'll say, but Ken, ETH is up. Well, it was up before Bitcoin started to come down, and ETH has come down less and it's not gone negative. That's the reasoning behind that. So what does this mean, and what's the important for us in September? You must keep your eye on Bitcoin. Bitcoin is a leading indicator of stock market risk and what the direction and momentum of the alts will be, either to the downside or to the upside. Okay, but if you're not inside the crypto market, you must understand that the stock market's gravity, the individual stocks can't escape it. For example, if the indexes are coming down like this, your individual stocks, say Nvidia or Microsoft, Tesla, it doesn't matter what it is, they'll be following suit. It also goes the other way. If the stock market is going up, your individual stocks will be raised up right with it. How do we use this in practice? For example, if the S&P 500 is coming down, the NASDAQ is coming down, the Dow, the Russell, they're coming down. That negative pressure will throw pressure across all of the different sectors. Some will come up, may come up. It realistically depends on the structure inside those areas. And what we saw on the tail end of Friday's session inside the US, we had a lot of red, and especially in the semiconductor area, Tesla got whacked. But just like in the crypto market, there are always areas of green. The key to understand, so many people, if they're just trading Nvidia or they're just trading Tesla or investing, of course, or they're looking at Apple or Google or Meta, whatever they're looking at, it doesn't matter what that thing is. They generally just treat this as the entire universe that exists. And they say, well, I'm putting money into Berkshire Hathaway, so yeah, I'm just going to see BRKB, I'm just going to look at that. I don't care, semiconductors, auto manufacturing, I don't care about that. I'll just look at Berkshire. That is a really dangerous move, because if the NASDAQ and the S&P 500, the Dow, are starting to do this, guess what's going to happen right here? it's going to go down. It's just the way it works. But Ken, I'm not in the US market, I'm not in crypto market, I'm in the Australian market, or I'm in the Hong Kong market, or I'm in the Singapore market. Doesn't matter. Rule 217, no stock market anywhere can escape the US market's gravitational pull. Now, how can I prove that out to you? If we look at the S&P 500, you can see this is on a daily basis, and we're looking through just that March to May area. You can see that the S&P 500 just tanked down. The NASDAQ tanked, the Dow tanked, the Russell tanked. But what about the Nikkei? Did that tank as well? Yeah, sirree, it did. What about the DAX in Germany? What about the Hang Seng? Yes. What about the ASX in Australia? You got it. This is what it means by no stock market can escape the US stock market's gravity. And we can also see Bitcoin overlaid there. Bitcoin is the kind of the canary in the coal mine. If there's noxious gases in financial markets, the canary will die first. That's not very fair to canaries, is it? Is it a pre-drawn conclusion that the markets will fall over? No, it is absolutely not. We have to look at structural passes and structural failures. We've got an idea of retail sentiment, but remember what retail means. Please let me know, what does retail mean to you? Rule 240 can just get rid of so much confusion in the markets. When we put CTKS structure first, what that actually means is that we're looking at the charts via structure. I'll show you exactly what that means. And we're seeking to answer the question, is September an up or down month? When people talk about market structure, they're basically talking about recent indicative price structure. They'll say market structure exists here because price came up, and obviously, it's just obvious, there was overhead resistance there and it went down. And obviously there was support there and it went up, and obviously there's resistance there, and obviously resistance, and obviously support. But there's a problem with this. When you look at the S&P 500, the S&P 500 has not been trading for 2 weeks. It's been trading for literally 56,000 days since 1871. Now, what does that mean? When you take 2 weeks and divide it by all of that time from 1871 to the current day, you've got a really small percentage. Now, what does that mean? It means that you're making decisions based on literally no data. Now, retail does that. Retail excels at doing that, and institutions wouldn't even dream of doing it. And I believe this is the actual reason why people lose money on retail thinking. Retail thinking just doesn't know where to buy and sell. It has no idea whatsoever. Now, what do I mean by that? Well, okay, let's throw on a retail indicator, which is just all the moving averages. So a moving average right down here for the S&P 500 would say, oh, that's a fantastic place to buy. But was it a fantastic place to buy here? It went lower. Oh no, that's a fantastic place to buy. It's this continuous moving target. When I was teaching first and second year statistics at university, one of the things that I said, an average, you can be average temperature. If one arm is burning and one arm is frozen, you just, in the average, you're just normal temperature, but you've lost both arms. That's kind of like what moving averages do in exponential markets like what we see inside financial markets these days. How do we overcome this problem? How do we figure out where the resistance levels are where there's no moving averages, and where the support levels are when there's no moving averages either? Most people, most retail use moving averages. And I would suggest that if you're doing so, don't worry about throwing them out or anything. Use them. If it works for you, that's fine and fantastic. But what you need to do is you need to look at a chart from an institution of one perspective. You definitely don't want to be retail, because if you're retail, you're going to consistently lose money. And retail is also just swept away by their emotions. As soon as they see red, they basically sell. When they see green, they basically buy. And they're getting cut to death on either side, continuously. Unfortunately, it takes a degree of time, even if you know structure, to unwire this emotional behavior. It's just a rite of passage inside the markets. Now, what we're going to do is just to zoom into this shaded area, and then I'll pop on this indicator from the service. Now, you don't need any indicators from the service at all. You can mark up your own charts with level 1 and level 2 standard certification. And I would urge you to learn the certification to see what institutional traders and investors see, to approach the market in such a way that you can make money from it, not just consistently lose. Okay, let's look into that area. I'm going to zoom in. Okay, we've zoomed in there. Now, when we look at this, we have no idea where the structure is. If you throw moving averages, they're non-structurally aware indicators. Now, what does that mean? It means that they don't know where the buy and sell structures are. For example, this purple line was the previous all-time high for the S&P 500. Technically, when you get above that, you should be in price discovery. What does price discovery mean? It means, well, you're discovering price. There's no resistance above. Again, a retail concept. If anybody talks about price discovery, you know there's no such thing. There is always structure above price, and when things are getting really dark, there's always structure below price as well. Just get rid of that background so I can help you to look at it more effectively. So what do we see here? We can see right here at around that 64.25, the 64.32 mark. That is the level that we must hold. If we come down to here, and we can overshoot it, especially when people get panicked. This is a panic up. You can get panic downs. This is like a God candle. You can get hell candles as well. Financial markets cater for all sorts. Now, what we need to do here is to look if we get a structural pass or a structural failure right here. It's also coming up into a recent area that a lot of retail will be looking at, so this is vital. Now, the institutions are likely to push it down and do something like this, so they'll push it down because they want people to panic. Your emotions are highly profitable to institutions. A lot of people say, oh, okay, yeah, Ken, I really understand that. So I need to get a trading bot. I need to get a bot, or I need to get something that's not me. Well, you know, that kind of strategy is definitely a strategy and it's something that you can do. But the better strategy is to learn to control your emotional state. So when you see lots and lots of red inside the market, that's actually an ideal time to get in. And with CTKS, we do something really unique and very unusual, but that's a topic for another video. We can make money in any market condition, but we do so very intelligently. If you would like to know more about that, please drop a comment and I can cover it off in future videos. The issue here right now is this 64.25 area. If we hold on to 64.25, we're looking good. If we bounce from it, Bitcoin is going to go higher. All your alts are going to party. Now, what happens if we don't hold on to this level? This is how institutional traders and investors look. They look at a chart and they understand where the real structure is inside that chart, and they say, okay, if it's not going to hold here, it's going to go lower. Where will it go lower to? Well, a confluence of structural support levels, and not recent indicative so-called market structure support. That's for retail. We do not do retail inside this channel. Actually, the entire reason that I started this channel was to move people out of retail thinking, and to help you to be more of a financial blessing to yourself and those you love. Now, what happens in here if we come down or if we go up? We can see that 64.90 is the next area of more solid structural overhead resistance. Remember, this purple line was the previous all-time high, where people were just saying, price discovery, retail, retail. You can always hear retail through emotion. As a professional, and that's what you are, you're here, you're a professional, or you're on your way to become one. What we do is we can't hold just a purely negative, even if the probabilities are stacking to the downside. We can't say, oh, it is definitely 100% going down, Because what if it hits the 64.25 and then bounces up and takes this one out, the 64.90 and the 65.20? If it does that, and of course we're looking at this because Bitcoin will follow the S&P 500. You must think from a risk management perspective. Do not just buy into a story, oh, it must go down because it's always gone down. Well, it hasn't always gone down. And if it always had gone down, that doesn't mean it's going to go down this time. All we look at is the structure inside the chart. Is it passing? Is it failing? Did we do a structural pass or a structural failure at 64.90? We failed. We didn't manage to get above it, consolidate it, and move higher. We structurally failed there. We structurally failed at the 64.72 mark. But unlike just about everybody else, we know exactly where the levels are. In advance, we know where they are, where they reside. And that's how you read this indicator. You read this indicator from and to the right, not to the left. We now have a line in the sand when it comes to the S&P 500, but where's the NASDAQ's line in the sand? We can see that from a retail perspective, people would be expecting if it goes underneath this very short-term support line, it's going to go down. But of course, it goes down and then finds support and comes up as well. Its price is always moving in a wave. So the issue is not that it comes down, the issue is where is the support, and of course, where is the resistance. So we'll do the same thing. I'll just zoom in here and we'll throw the structural indicator on. Okay, now that we've zoomed in, let's check this out. We can see that there's structure here. So it did do a structural failure at that 21.63, but this is not actually a structural failure at the current price where it's at. There's a lot of negativity inside the market, but we can see literally around this 21.302 level, that's the next level of structure that we need to hold. So we have just currently two levels of structure, one on the NASDAQ, one on the S&P 500, that will pretty much dictate where this month goes. Don't worry about the stories, don't worry about the news headlines, just look at the structure. One of the other things that I do, apart from releasing these TradingView indicators on the structure, I do what are called three-dimensional price paths, or CTKS paths, and do a video inside the service. I do these paths at the start of the month. They are drawn structurally, not to reflect price, because price isn't there when I draw them. We may have a couple of bars, but the majority of the bars are not on the price chart. What these bars do, or what this structure does, it seeks to understand if structure holds under normalized price conditions, where is it likely to flatten out? And for example, in the DXY, and the DXY is going to be important to keep your eye on as well, because if the DXY starts to spike up, it's literally a flight to safety. When you get flights to safety inside the market, people are throwing their money out of stocks, out of commodities, out of crypto, and throwing it into fiat currency. It's like inside the crypto market, we throw it into stable coins. It's very similar. So we can see that the DXY has gone negative this month and has followed that normalized negative price path. Before, it was following the normalized positive price path. These may sound like a really easy thing to do, but if you're trying to predict where price can go at the start of the month for the end of the month, also seeking to contain as much of price as possible, it's actually not that easy. It does take a lot of expertise and experience, and you'll learn that in Level 2 Standard Certification. The other thing that you'll need to keep your eye on is the VIX. The fear gauge of the main markets is very, very important. When the VIX spikes up, and you noted the VIX spiked up and the DXY spiked up as well. So on the cheat sheet, just remember to look for those things. If the DXY and the VIX are spiking up, that is confirming that we are likely to lose the structural support on the NASDAQ, on the S&P 500, and that's going to throw a lot of negativity into the crypto market. But if it doesn't happen, if the VIX starts, or the fear gauge, it starts to go more and more negative, that is really good for crypto. And of course the stock market as well. This particular white line is the S&P 500. So when the VIX spiked up, the S&P 500 took a nosedive. But as soon as the VIX went, yeah, I done enough, look at that, it hammered in the bottom. Now typically people are not in the market when this happens because they've been thrown out by their fear. You need to invert this way of thinking. Remember, retail loses money because retail is utterly emotional. If you've ever seen these Wall Street cheat sheets and things like that where it's all emotion, it's emotional roller coaster up and down, that's retail. You are an institution of one. You look at fear in the eyes and you say, "Pah." Let's throw on the price paths from the service video. Now, how did they go? Well, they went pretty well. The VIX did spike up and literally closed out on the positive case. But what have we seen this month? We've been following the negative case and we've still got 1 day left. Mark up your charts from US market data, please. I cover this in level 2 standard certification, but you really need to keep it in mind. If you mark up on the wrong day, you will have the wrong chart. Literally, all your levels will be wrong. It's very important to mark up your charts on the right day, but also mark up the correct chart. Now, looking at the VIX, if we find that the VIX actually just spikes up a little bit and comes down, it could close out on that 1377. And in the video for next month, or this month's service, I'll be doing these price paths from the start of the month and just projecting them forward like we always do. And there's a full archive, full history inside the service. So you can literally look back at time for what happened in the past. There's a huge amount of very, very valuable content in there. Now we can understand what we need to look at in terms of different charts, and just remembering all charts are intercorrelated and interconnected. We can see just right at the current time, at the recording of this video, the crypto market was selling down. It's currently 3.69 trillion. But what we need to do is to understand what the structural levels are and what's been violated and what's structurally passing and structurally failing. We can see these areas of structure up here, they've failed, which favors a gravitational well around that 3.7. Now, what does that mean? It means that it can come down hard and reverse hard because just like, gravitational wells just capture price. When it overextends too far, it generally flips back. So this is something just to keep in mind. But there is an area of structural support at that 3.7. There is a lot to making money inside financial markets, but once you just understand what you're doing, all of the charts are intercorrelated and interconnected. We can see a bit of a sell-off, and of course, people now starting to talk about, September is the worst month ever, and everybody should sell, and there's going to be so many open mouths and gasping, hell candles breaking loose. Fantastic to get you to click on the damn video that you're watching. But does it help you? No, it doesn't. That's why I believe we must share these videos far and wide. We need to help people to just disconnect from emotion. All those emotional thumbnails, they're meant to elicit fear. And while that may be good for the channel owner to just terrify you every 3 seconds, it's not good for your account balances and it's not good for your state of mind. For example, when something is plummeting like this, the thing is going to go to zero. Hang on, I'll sell, I'll get out. Oh no, what the heck? I'm not going to buy it now. I'll wait till it's up here and then I'll buy it. Oh no, what the heck? It went down again. Okay, it came up. Now I'll buy it. Oh, what the heck? You get the idea. This is always happening inside the market. You cannot be just thrown out of the market on a red candle. Your account will get cut to shreds. Please let me know in the comments, is there something that I can do to help you out? Any kind of content that will help you to just get your mindset in a better place for this. And of course, one thing that I know will help, because I do it, is to come across on YouTube to @CTKS Method. Just click that and just go down. We actually put out the chicken trader video. It's just a bit of fun. But go into the playlists, and the playlist you can play this, and these songs will structure your thinking. And just maybe put it this way, after being inside financial markets for nearly 40 years, wow, I'm getting old, I put this music together with Kate as well to help you to understand how to think, how to deal with the red, how to deal with the green, how to deal with structure, how to deal with so many things. It will make you money. And again, I think these are things that really need to be shared. So if you have a favorite song, share it far and wide. Share it all through social media. Get other people interested in making money. And in this day and age, we really need to have alternate things rather than jobs. AI is coming for that job. Making your decisions based on structure is a very, very clever thing to do. That means that you can just close down so many news sources and just look at the charts and understand where the structure is from the downside and also to the upside. It's extraordinarily powerful. Please let me know in the comments, do you anticipate that the September month is going to be a negative month like we've seen across many different years, or do you think that we might find structural support and go higher? I'm really interested in your comments. And what specific levels are you looking for to gauge if it's either going to go positive or negative? The key is not to have a fixed concept on prices absolutely going down or absolutely going up. Don't worry about those things. Just worry about structural passes, structural failure, and structural location. And of course, keep the interplay between all of the different charts inside the cheat sheet. Keep that in focus. And always remember that when you have the service indicator, you read it to the right, not back to the left, to the right. It's a very important distinction. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.